Imagine you're at a party. Everyone's drinking champagne they bought with a credit card. The music's loud, the vibe is perfect, and someone just bought a second house they can't afford. You look around and realize nobody here has any actual money. But the party doesn't stop. It gets louder. That's not a metaphor. That's just what happened in 2008 and 1929, and about a dozen times in between. Economic crashes don't sneak up on us. We throw them a parade first. Here's the thing about crashes. They're not random. They're not acts of God. They follow a script so predictable you could set your watch by it. And yet, every single time, we act surprised. Markets collapse, banks fail, retirement accounts vanish, and everyone asks the same question: how did we not see this coming? We did. We just didn't want to believe it, because believing it would mean stopping the party, and nobody wants to be the person who turns off the music. Let's start simple. An economy is basically a giant game of trust. I trust that the paper in my wallet is worth something. You trust that your paycheck will clear. The bank trusts you'll pay back that loan. Remove that trust, and the whole thing falls apart faster than a house of cards in a wind tunnel. Most of the time, this works. You go to work, you get paid, you buy things. Someone else gets paid from your purchase. They buy things, round and round. It's a beautiful balance. But here's where it gets interesting. The economy doesn't just run on money that exists. It runs on money that might exist someday. That loan you took out? The bank doesn't have that cash sitting in a vault. They created it the moment you signed the papers. Your future paychecks just became present-day spending power. This is called leverage, and it's not automatically bad. Leverage built every skyscraper you've ever seen. It funded every business expansion. It helped your neighbor buy that house. Leverage is how economies grow. The problem is, leverage is also gasoline. Very useful, very powerful, and incredibly flammable. Every crash starts the same way, with optimism. Something goes up in value. Stocks, houses, tulips. Yes, that actually happened in 1637. Doesn't matter what it is. What matters is that it went up yesterday and the day before that, and people start to notice. Then they start to extrapolate. If it went up 10% last year, surely it'll go up 10% next year, maybe 15%, maybe more. The math becomes a promise. The promise becomes a loan. Because why save slowly when you can borrow now and profit later? This is where things accelerate. More people buy in. Prices rise faster. The people who bought early look like geniuses. FOMO kicks in. Fear of missing out isn't just a social media thing. It's the engine of every bubble in history. Your uncle who barely graduated high school is suddenly giving stock tips. Your hairdresser just bought 3 rental properties. Everyone has a cousin who retired at 30 trading cryptocurrency or flipping houses or investing in some new thing that can't possibly fail. When the least qualified people in the room start sounding like experts, you're close to the top. Here's the uncomfortable part. For prices to keep going up forever, you need an infinite supply of new buyers with an infinite supply of money. You don't have that. Nobody does. But for a while, you can fake it. Banks start lending to riskier people. Standards drop. Someone who couldn't get approved for a credit card last year is suddenly holding the keys to a $400,000 house with 0 down payment. The bank doesn't care. They're not holding the loan. They bundled it with 1,000 other loans and sold it to someone else. Now it's their problem. Except it's not just their problem. That bundle got sliced up, repackaged, and sold again and again until nobody actually knows who owns what or how risky it really is. The original loan, the one to the person who maybe shouldn't have gotten it, is now buried inside a financial product so complex it has a name that sounds like a dessert: collateralized debt obligation, mortgage-backed security. Wall Street has a gift for making dangerous things sound boring. Then something small happens. One person can't make a payment, then another. The defaults aren't dramatic at first, just a few percentage points. But remember all that leverage, all those loans built on promises? They're not designed for even small failures. The machine starts running backward. Prices stop rising, then they plateau, then they dip. People who bought at the top are now underwater. They owe more than the thing is worth, so they sell. But everyone's selling now, and nobody's buying. Prices fall faster. The banks that loaned all that money, they want it back, but the collateral is worth less than the loan. They're stuck. Some of them gambled too hard and don't have enough cash to cover their own debts. The trust that held the whole system together starts to crack. One bank fails, then another. People panic. They pull their money out. More banks fail. Credit freezes. Businesses can't get loans to make payroll. Layoffs begin. Unemployed people can't pay mortgages. More defaults. More selling. The spiral feeds itself. This is a crash, not a dip, not a correction, a full system failure. The absurd part? We know this pattern. Historians study it. Economists write papers about it. We have literal centuries of data showing what happens when speculation outpaces reality. And yet, in 1929, people believed the stock market had reached a permanently high plateau. Those were the actual words used. Months later, it collapsed and took a decade to recover. In the late 90s, we convinced ourselves the internet changed everything. Traditional metrics didn't matter anymore. Profits, revenue, old thinking, just have a website and a dream. Then the dot-com bubble popped and $5 trillion evaporated. In the mid-2000s, we said housing prices only go up. They never had before, not nationwide all at once, but this time was different. Except it wasn't. 2008 happened. Every generation thinks they've figured out a new paradigm. Every generation learns the same lesson. There is no new paradigm, just new packaging on old mistakes. Here's what makes crashes so destructive. The people who caused them usually walk away fine. The banker who approved 1,000 bad loans got their bonus 3 years earlier. The CEO who over-leveraged the company already cashed out their stock options. The politician who deregulated the industry is safely retired. It's everyone else who pays. The teacher whose pension fund was invested in those toxic assets. The factory worker laid off because their company can't get credit. The family that bought a house in 2007 and lost everything by 2009. Crashes don't punish the reckless. They punish the average. And the wildest part, we don't even learn. After every crash, there's a moment of collective panic. Regulations get passed, hearings are held, everyone swears it'll never happen again. Then time passes, memories fade, regulations get rolled back because they're stifling innovation, and someone, somewhere, figures out a new way to package risk and call it safe. The cycle begins again. So here's the question nobody wants to answer. Are crashes a bug in the system, or are they the system? Because if you step back and look at the pattern, crashes might be exactly how this is supposed to work. Boom, bust, repeat. Wealth concentrates at the top during the boom, then when it all falls apart, the people with cash buy everything on sale while everyone else is still trying to figure out what happened. Maybe crashes aren't failures, maybe they're features. You don't have to like that idea, but you should probably think about it the next time someone tells you this time is different. The next time prices seem too good to be true. The next time the party's getting a little too loud and everyone's a little too confident. Because history doesn't repeat itself, but it rhymes, and we're all terrible at recognizing the rhythm until the music stops.